don't forget to mute everyone first. Sorry.
I didn't forget to mute anyone. I did. Sorry. Hey everyone, welcome to another edition of the Buddy Study Group. And I am here with two ladies that I respect and look up to very highly, Phyllis Shelton and Linda Tallheimer, also study group veterans in their own right. And today we're going to be talking about a topic I try to cover every single year, and that's working with financial advisors. So last month, I did the self-funding presentation. A lot of the topics there are going to go hand in hand, but I want to talk about specifically the relationship between financial advisors and long-term care specialists because, as you all well know, it can be two completely different sides of a coin, right? In one hand, I think it is the absolute best referral partner you could ever have is a financial advisor as a long-term care professional. But I also hear many people reporting to me that, oh, I had this great case, everything was going great, but then they mentioned they had to check in with their financial advisor and I lost them completely. Radio silence. So I think there are pieces to working with financial advisors that can be amazing, take your business to a completely different level, and every financial advisor needs a long-term care specialist. Every long-term care specialist could use a financial advisor, but also there are times where the experience can be a bit frustrating, especially if you're not able to reach that financial advisor and speak to them yourself. So, Phyllis, Linda, thank you very much. I know you both have very, very deep experience working with and maybe even competing against some financial advisors. And I wanted to start the discussion just by talking about, especially for you, Linda, because you work with so many financial planners, local to you and otherwise, why it is so important to try to work with as many financial advisors as possible as referral partners.
Well, long-term care is a product that is complicated and expensive and confusing. And when you work with a financial planner, you have a quarterback in your midst that keeps sending the person back to you, right? So as soon as the financial planner refers you, you have taken away all other um, uh, potential people that they would look for, right? So that like there's no competition at all. For financial planner refers you, it's only you. Now it's up to you. And if for any reason that person is still antsy, you've got the financial planner on your side, so to speak, to bring them back to the table, right? So and and they will also help you educate their clients. So for many people, long-term care has to be heard over and over and over and over again. I want to say like my greatest relationship with one of my earliest financial advisors was where I created a very short video. It was 7 minutes, and the financial planner played it for every single client during that first initial setting up of the portfolio. And basically all he had to say, and so he was trained, right? It was, and long-term care is an important part of financial planning. I just want you to watch this quick video. After the video, he says, I'm going to call Linda and have her reach out to you to talk about long-term care. Is that okay? So it is an assumptive close on the financial planner's part. And so very effective way. They already know you. They've already seen you. They've already heard from you. They've got this general understanding about long-term care. They've got their financial planner's support and the potential for them to accept your meeting call is 100% and have that first meeting. And then it's just a question of closing. I can say that only people with that advisor that I did not close were not health qualified. And that would not even have been a problem today because we have so many options available, right? So very, 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 very high close rates with financial planners who you have either have their own perception of the importance of long-term care, or you have been able to convince them of the importance of long-term care. So sometimes you'll meet a financial planner. I just had one the other day. A client said she was going to meet with her financial planner. I said, can we just all meet together? And if they do, that is ideal, because not only are you going to close better with your client because the financial planner's there, but you also now have this new financial planner listening to the same story. And now you'll have hopefully another financial planner to get referral business. And it's a very exciting process when you have a new financial planner to explain why you chose this policy for this person. And then you take them right into the buddy system and show them the cost benefit, right? So you talk in their terms, you have your education, and they hear about all the different types of products and why you chose what you did and the cost value of them, and any additional benefits that they may not have been aware of, such as mess up lien law or partnership and all those things. And now you've got a financial planner for life.
Yeah,
So
I think super, super well said. I mean, what you said in that few minutes, so many things you can pull out of it. I think one of the big things is that the value there is the implicit trust that can work against us in competitive scenarios, right? Unless we're able to get that financial advisor into a call. But, financial planners, especially very holistic financial planners, whether they're kind of doing everything themselves or they have a person for each kind of corner of financial planning, they have the implicit trust of their clients. And if you are the ally instead of the competition, you are basically going to pull those leads in like a magnet, especially if you set it up like you have, Linda, where you onboard them and train them in a way where it is impossible to mess up the handoff, right? I have a quick video because long-term care planning is important. This will introduce you to Linda. I'm going to set you up for a call with Linda. I mean, that is a process that, many people dream of having, um, even just one, right? Even just one referral partnership like that. So I think that all of that is hugely important. Now, Phyllis, you have trained probably countless financial advisors with long-term care planning, long-term care training, CEs, whatever it may be. What do you find as somebody who may not be 100% 24/7 exposed to long-term care? Where do you find the gaps in the knowledge of financial advisors, or where do you find that, folks are making assumptions about long-term care that you have to correct?
I think the biggest issue is the cost of care. And I have sounded like a broken record for so long about this, but I don't care. I'm going to continue on. I've been in this field for, I guess, coming August, 38 years. 38 years, yeah. And I have used the 5% compound as the projection for future cost. Now, I realize, we don't sell 5% compound anymore, rarely, because of the cost, but you can compensate for that by bumping up your initial daily or monthly benefit. But as far as my projections on the cost of care, I'm right on it. I mean, at 5%, a cost will double every 15 years, okay? Every 15 years. And I can tell you right now, when I got started in the high cost areas, we're talking California, Connecticut, and all that, nursing homes were $100 a day, 60 in lower cost like Tennessee, and then all you have to do is do the math, and that's nursing home cost. But I always try to disarm people by saying most people are never in a nursing home, which is true. Less than 5% that meet the criteria to get a claim paid wind up in a nursing home. But here's what we're finding. I mean, if you're talking about wealthy people, Diane and I worked on this case where this guy was in San Diego and he wanted round the clock care and he wanted cash and he wanted this and that, and we were up against a team of people at Merrill Lynch, and we were just showing him that in 20 years, and the guy was 65. So in 20 years, to have that home care with that cash, with that flexibility, with everything that he wanted, would easily, I mean, easily be 3.5 million and could be quite a bit more than that. And I was just looking a minute ago. I mean, people are spending $250,000, 300,000 today for 24/7 home care, right? And so just roll that forward, 20 years from now, and just think about how astronomical it will be. Now, I think with these cash policies, you'll see a lot of hiring of informal caregivers. You'll probably see an elder gate because they'll be hiring them and not taking care of their Social Security and their unemployment taxes and all of that. But even with that, the cost is just astronomical. So I think it's extremely important, if you can ever get a financial advisor to understand how big, how very large that amount is. That's, I don't know what Linda thinks about that, but I think that's a big part of getting that person in the boat, because they can do all their Monte Carlo assumptions they want. But if they don't have that kind of knowledge, and of course, Linda's been on the care side as well with her work in occupational therapy and all that. But if they don't have that kind of knowledge, how on earth can they plan to protect a client when they don't even know what the cost is going to be? I mean, that is like shooting darts in the dark and not even being able to see the target.
Right. Yeah. And I think that leads into one of the bullet points that I want to cover, is how to really get an advisor to understand your value to them as a long-term care specialist. I think, folks who can understand it from a surface level, logical perspective are out there, but there's a lot of depth involved in being a long-term care professional, not just knowing intimately the costs of care, projections out into the future, but like you said, the care side of things. I worked with only financial advisors for a good 5, 6 years of my life, and I will tell you, probably the most frightening thing to them is a call from a client saying, I think I am actually on a long-term care claim. Where do we go next? Even if they were just the only one who wrote the policy, they might not be connected to an actual specialist. Maybe a broker has helped them obtain a plan, but they're not truly working with a long-term care specialist. So the rubber has now met the road and they have no clue what to do. And there's a feeling of incompetence there. And oh boy, I might have wrote a check that my butt can't cash because now I have to figure this out. There's a lot of value in just who you're connected to on the care side, whether you're working with it directly like Linda does on the claim side, or being connected to partners like Amada Senior Care who can help with policy activation, who have home healthcare franchisees who can help you take that next step. But what are some other items that come to your mind as far as the depth of knowledge you have to make sure an advisor is aware of, to either prove your value or understand, listen, there's more to this long-term care picture than just setting somebody up with a plan?
Yeah, so there's
Yeah,
two.
and self-funding, what's that going to do for people at claim time? So I'm going to toss it back to Linda, because that whole detail, and what I talk about to them though is not going to be you. It's not going to be you. And we've already covered who their important people are, whether it's children or it might be a nephew or da 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 da. And I get the names of those people. And I say, okay, you're worried about Andy and Sarah, right? Okay, let's talk about what this can mean to Andy and Sarah. If you self-fund, they've got to figure out, where is this money going to come from? What are they going to sell? What are they going to do? Where is it coming from? They're already in a state of shock, in a state of stress. And, the last thing they need is to figure out all the finances. Whereas if you have a plan, and I don't care how wealthy you are, if you have a plan, here's where they go. Here's where they go. And then they can work with this company and get this concierge service to show them how to file a claim and so forth and so on. But getting to the heart of what it's going to do to those people when it becomes claim time, I think that's really important. And Linda, you talk about the depth of claims knowledge.
Yeah, I do. But I usually start from the financial planner's perspective first, which is, so you do a financial plan. So let me ask you, how long do you make these plans out to our age 90, 95, 100? And there's nobody who's making a plan for less than 90 years old. If you're a decent financial planner, you're making a plan out to 90 years old. And
Right.
many are making them out to 100, right? So then I asked the next question, oh, that sounds great. I said, so let me ask you, are you surprised when your 90-year-olds, your 95-year-olds, or 100-year-olds need some home care, assisted living, adult day health, hospice, or nursing home? And they're going to say, of course not, right? Say, are you aware of the cost of that care? And then you just let it sit there. And then you say, well, let's talk about that, because, you know, obviously this is a part of planning. So let's talk about, and then we go right back to Phyllis about what she was saying is how much cost of care is, you know, and the averages are just not the averages. I mean, right, you know, I help people with claims all the time. And I can tell you, in Massachusetts, we're looking at minimums of $40 an hour.
Yeah. Today.
Minimums
Today.
and some of them are $50 an hour. So you're talking, you know, $6,000 for one shift of care, right? That's continuing to grow at 5%. So then when we talk about the cost of care, and then we say, so, Mr. Financial Planner, how much are you allocating from the estate to fund long-term care? And because, you know, I say to them, it's really important to take the money out of their living expenses, right? Because long-term care expenses are at the end of life, and you don't want them spending their estate money that they need for long-term care. So what are you putting over here in this long-term care pool? Because
and for how long? And for how long?
And for how long? So if we're assuming a 5% rate of return, and we may assume that they might need to go into claim at age 85, you know, and we look at that, and we don't know how long they're going to need care, right? So we could be projecting, you know, $1 million plus in this pool. And then the question is there a better way than dollar for after tax dollar of putting it in this pool? And let's just look at it, right? And we talk about, you know, that the wealthier people, we can go for real leveraging with longer policies. And the people who don't have a lot of money, we really want to take advantage of the partnerships and the Mass Health lien laws to give them that added protections, because it's going to be a mess if they need long-term care and they're not one of those lucky ones who don't need it or use a very short stay. Their entire state's going to be wiped out. And then what? Where are the protections? So long-term care is just more than the protections. It's those added catastrophic protections for the people who are just bordering on whether or not they're going to be able to make it if they have a real long-term care event. So,
and Jason, I thought you did a great job on when you did it. And I actually picked up a phrase, and I think you'll have, maybe it came from Gene Cutler, we'll see. But the phrase is, at what point is someone wealthy enough to want to overpay for anything, a boat, a house, a ring, you know, whatever? When do they want to overpay for it? Which is what they're doing when they're using their pre-tax IRA money, 401k, anything like that.
Yeah, that's John Wheeler, and I'll say that every time I do that presentation, because it again just enforces the idea that insurance is not just this thing I'm trying to propose to be a bummer. It is actually a better deal, and for those who get to that level of wealth, they don't get there by intentionally overpaying for things. They make efficient, sound decisions with their money, be it on the saving side or be it making efficient investments. They tie the right vehicle to their objective every time. That's how they get there.
And I'll give Linda credit for this. At what point would you turn down a 50% discount, a 50% off coupon for something that you really want to buy or need to buy? When would you do that? So if the policy does pay for half, then that's a 50% discount, or it could be a 30% discount, whatever it happens to be. But I know I always tell people, I hope you never need this. Really, I hope you die in your sleep, you know. But I give them that whole concept of, would you rather spend $6,000 a year, $10,000 a year, or would you rather spend $30,000 a month? Which one would be more comfortable for you?
And it's important for people to know that small policies have tremendous value.
Oh,
So
yeah.
what I usually, tell people is this, is that, that we don't know if you need a small amount or a lot of long-term care, but I can tell you that when you enter into claim, you have no choice, right? So you have your choice now of how you want to protect yourself, over a small period of time or over a longer period of time. But once you need care, it's just an immediate spend down of your assets. If the market is down, your money's not going to be able to recoup.
Right.
And it is scary. It is scary because of the amount of money. And it's not just the absolute cost of like assisted living. You'll want additional caregivers in the assisted living world. I mean, the long-term care is a very scary place to be because you need so much help and it's so expensive. And
Mhm.
so even small policies make things better. It's something good during a really bad time. If you spend this money and you live a long, happy life and you die and you've spent a little extra money while you're doing it, it's not a big deal. But when things go bad, you need more money than you ever did before because you need to provide quality caregivers. And the only way you get quality caregivers is with private dollars.
Mhm. Yeah.
And let's
100%.
face it, if you were an aide and you have a choice, you can work for a private agency with a minimum of 4 hours of care, which means that you get somebody bathed, dressed, and toileted once, and then you do a little shopping, you play little cards, you play with your cell phone for 4 hours, you make them lunch. Or you work for a government agency and you go from house to house to house doing bathing and dressing and toileting, bathing, dressing, toileting, bathing, dressing, and toileting. Which aide do you think would want, so obviously the higher quality aides are in the private agencies.
Amazing point. Yeah, amazing point. And I don't think that's thought enough or talked about enough, to be quite
Or they're doing
honest.
private duty. These wealthy families are just hiring a person. I actually have a family member who kind of fell into that work, and she stays in the house and becomes a primary caregiver
Right.
Yeah.
Yeah.
for a lot of money, a lot of money.
Mm-hmm.
Yep. Super good
Mhm.
point. And one of the other things that I think about, it's not just that financial advisors are a great pairing for long-term care specialists. We kind of talked about the depth of knowledge and what's required to kind of do the due diligence as a long-term care specialist for financial advisor clients, but you're also protection for that advisor because when you are able to help their clients understand the value of insurance and kind of, take that step and protect themselves in that way and leverage an insurance company's checkbook, you are also protecting that advisor's AUMs. You're
Mhm.
protecting their legacy AUMs, which at times are, and many times are more lucrative to their business, but you also keep them from getting egg on their face and kind of inadvertently disobeying their clients' wishes, right? At the
Mhm.
end of the day, one of the biggest things that advisors and financial planners will hang their hat on is legacy planning, especially for their most wealthy clients. You can't take it with you when you go, so you need to, have a plan to leave a legacy behind and cutting into that with a, completely unmitigated extended care event that's going to be egg on your face. That's going to be, why didn't you foresee this or go through this exercise for me or figure out a better way so that it's not cutting into my objectives we've been working on for 10, 20, 30 years.
Yeah,
So
and I love this one. Is there any other item that your financial advisor is telling you need to pay full price for?
yeah.
Gene may have said that. I'm determined to give him credit for something. But I mean, it's so true. It is absolutely true. And not just egg on the face, but errors and omissions.
Yeah. I was
Yeah.
thinking, I always tell them, if you were in a court and a child, a parent spends down their estate, their inheritance, right? So the kid's unhappy and the kid goes to a court and says and the judge says to financial planner, how long did you make this financial plan out for? And they say 90 years old. And you're not surprised that you didn't do any planning for a 90-year-old that they might need care? I mean, that's like a ridiculous statement, right?
It's
I mean,
negligence.
it's
It's negligence.
negligence to not think that a 90-year-old or a 95-year-old might need care. Now, if they were making financial plans out to 75, hey, you know, may make sense. We don't have a lot of 75-year-olds in claim. They also wouldn't have any money when they lived a long life. But I think they have to appreciate that they're planning these plans into old age because they honestly believe that people could get there. And if they believe people could get to their 90s or to 100, they have to take with that all of the care and the decline that older populations have, and to be prepared for it.
Yeah, and it's hard to put yourself in that perspective just as maybe somebody who's not entrenched in the long-term care world. Even with other guests we've had on, I always think of Esther's presentation about setting up the home to actually be hospitable for receiving home care in it. Little things like doorknob modifications, egress in the bathroom, accessible ramps, things of that nature. We don't put ourselves in a position to think to that level about being that age or having those needs, right? And it's the same thing with financial planning. It's hard to put ourselves there unless we have an expert who is dedicated to thinking in that mode all the time. They're going to have the correct questions to ask, the correct items on their checklist to check off that you need that as a part of your practice. So I think everything we're saying here, I hope this gives people who are listening the confidence to understand that financial planners and advisors need you. They need somebody like you. And if that doesn't give you the confidence to reach those folks, I don't know what will. You know more than 99.99% of the world about long-term care, and the number one person who needs you is a financial planner who's working with all sorts of financially affluent, literate clients who are barreling towards this if they don't have some sort of expert on their team helping it out.
So here's
And I
some
can tell
ideas.
you, oh, go ahead, Linda.
I was
Go
gonna say,
ahead.
here's some ideas for you, because how do you meet a financial planner? So let's say
Yeah,
you can
that's
meet
where I was
financial
going.
planners. Oh, is that where you were going?
Yeah,
I
go
was
ahead.
gonna-
Go
I was
ahead.
gonna say that, so if you go to networking groups and you meet financial planners, right? So when you talk to them, you can ask them if they make long-term care part of their plan. Now, there will be some who say, oh yeah, I do it, I already do it. You say, oh, do you write it yourself, or do you use a general agency? Do you have a specific person? And for those who say they do it themselves, you ask them, so when's the last time you read a contract? They haven't. They will stop right then there. So before you actually, I should go back one step, which I usually do, is I usually say, let me ask you, how would you rate yourself as a financial? So when a financial planner says, I sell long-term care personally, or I use a general agency to do my long-term care, as opposed to I have a person that I know, love and trust, you ask them, I just care, how would you rate yourself as a financial planner? And everyone, of course, is going to be an A-rated financial planner. And then you ask, okay, so let me ask you, how many different policies do you sell? And usually it's not the entire bandwidth of long-term care. And then you ask them, when's the last time they read the contracts? And they haven't. There's very few financial planners who are selling long-term care who are actually reading the contracts. They might be reading glossy folders, but they're not reading contracts. So when they say that, I ask them again, so let me ask you again, how would you rate yourself as a financial planner? And then I always back off and say, I consider myself, you are obviously a financial planner, and I only focus on long-term care. I'm obviously an A in long-term care insurance. This is why I like to partner with financial planners, so that we can be the best to our clients, right? I mean, I don't do financial planning, and there's so much in the long-term care world, and there's so many different opportunities now, that financial planners who truly want to be an A financial planner and give their clients every option to have the best opportunities need to have access to everything, and need to know from the people who don't qualify for long-term care or don't have a lot of money to afford long-term care, all the way up to those that are, that are super healthy and want to protect over long periods of time. And then you can sit down and have a talk. But I have picked up financial planners just by, talking about who they're using and what their trust level is. Remember, if they're using a general agency and they're just calling up a large company, I won't use names, but they use the large company. When that person goes into claim, who's helping them? They don't have a person.
Right.
And that person
They
on
need
the-
an advocate. The word is
they need an advocate. And that person who just sold them is giving them quotes. Are they asking all the right questions? I was just talking to Mike from NGL, right? And what was he saying? He was saying that all of the long-term care companies are frustrated by the way financial planners and the general population are throwing business, against the wall. No underwriting. They're just writing apps and sending them in, right? That's a problem. We don't do that. We protect our clients from having to write multiple, to be interviewed time over and time over again, and to potentially lose the opportunity to get a good policy. And emotionally, when people get denied, you've just lost 50% of the chance that they're going to come back to the table to try something new because it feels personal. So, financial planners, if they're going to do what's in their best interest of their clients, need to work with people who truly understand the industry and are passionate about it. And the agencies are employees, and they come and they go and they're hired and they leave and they find new things all the time. And so it's much more difficult to get, if you have one person in a general agency that like and trust, who's been there for years, that's different. But it's a person as opposed to just, having an entire agency that's going to take care
Yeah,
of it.
and I'll add to that because I was the person for 6 years on the other side of the phone at one of these large brokerages, large companies. And I would say we did a lot better of a job of due diligence than most, as far as pre-qualification goes, as far as the long-term care conversation. I mean, we weren't pick up the phone, hang it up, and here's your quote. But we didn't have time to address everyone to the level that a true independent
Mhm.
long-term care specialist with a one-to-one relationship with an advisor is able to. It's impossible.
Yeah, it's a commodity. It's a commodity. And
it is.
back to that case Diane and I worked on, I mean, they were giving him quotes from some type of a UL that he would not have qualified for. And I think Diane figured out it would have been, if he had gotten it, it would have been like a table 8. It would have been so much higher. And the Merrill Lynch people had no clue. Plus, it was a limited amount of coverage to start with. But to them, it was checking a box. That was it.
Right. And you make a good point about declines, being the end of the road for some people. You don't know, if a carrier that potentially would have accepted them and may have been the only carrier that would have will now preclude them because of their decline experience, right?
Or like Diane just said, if they had waited a few months and
Right.
gone through a recovery period, they might have been able to. Well, speaking of checklists, may I go through my list of questions?
Yeah,
That would be good to.
I was about to transition us there. So this is going to be more centered around, I have to go check with my advisor, and I don't think he's going to be able to get on the phone, all three of us.
Yeah.
I think this is how you set up the conversation, Phyllis, with, okay, that's fine, perfectly understandable, but I want to make sure you're still being taken care of regardless. So I have some questions for you to ask your advisor to make sure that your plan is going to adequately fit your situation, right? For your 7 questions article.
Yep, and I'm going there, but I had to show everybody this. This is April 10th, and just came out from Kaiser Family Foundation. And it's just really showing what's happening as, again, in 2010, I was doing a tour around the country trying to say Medicaid is the real threat to our economy, and now they're talking about all the spending cuts, and on their tracking with 6 and 10 nursing home residents. They're saying nursing home residents, but actually, Medicaid in all 50 states now pays a little more for home care than nursing homes. So whether it's cut for facility or wherever the care is, home care, it's going to be deep cuts. and people are going to be cut off. In Tennessee, we've already had children, a lot of special needs children cut from our Medicaid budget. So this is just the beginning, the tip of the iceberg for what we're going to be seeing. And again, I still think Medicaid planning is a very big deal. I don't care what anybody says, especially in small towns, that we'll just transfer everything to the kids, or we'll do something and, you know, get away from having to spend our money. So this is, and I'm sure Jason can pop this in the chat, but what I'm hoping that you all use this for, and copy it, paste it, whatever, is to get, first off, Linda's whole suggestion, let's get the financial planner into the mix. Let's have a meeting, all of us together, so that you can ask the questions. But if the client is just going to go back and talk to the financial planner, then give them a list of questions. Because if they just say, don't you think I need to plan for long-term care? What are they going to hear? No, because that's money going out from that financial advisor's book of business. So, you know, get these answers. So how long have you estimated I might need care? And the average time, and this is from the Society of Actuaries, it's for people who need care longer than a year. That's what I care about. People who need care longer than a year, 4.5 years. And that actually drills down to almost 5 years for women, a little less than 4 years for men. Okay. And that's covering home care as well as care in a facility. But, you know, that doesn't take into account Alzheimer's and strokes and people who really need a very, very long time. We've talked about the cost of care. And when you look at a survey, I always add $1,500 to whatever that monthly cost is for assisted living facilities, because that is the median cost. That is not the cost of a really nice place. And that's what wealthy people would want to experience. And it translates that if you get the $1,500 on there, usually that translates to about 8 hours a day of home care. And you can check it. Years ago, home care was growing 1%, 2%. And I said, the day will come when the baby boomers start demanding care, when home care will outpace facility care. Well, folks, that day is here. It's happening right now. And home care is growing by leaps and bounds. The inflation factor, the financial advisors, what little they do know, they know that we're selling 3% compound. So when they're in, you know, projecting care, they're often using 3%, and I just will swear by 5%, and I think we'll be way lucky if it's not more than that. That's actually a webinar marketing I did on this at one time, so y'all can tune into that. So, and then what is the specific amount you're allocating? And which part of the portfolio is actually going to fund the cost of long-term care? So, and maybe you get at this by saying, hey, if you were to have a stroke 2 weeks from now, and you had to start spending, say, even $6,000 a month for care, what asset would you use? Which asset? And the client can ask the financial planner that, you know, if something happened to me now, which asset are you going to use to fund this care? So, and even at $6,000 a month, and that's not even touching getting into, you know, 10, 11, 12 hours a day of home care or more. But you're looking at $24,000 a month for a 50-year-old by the time you're 80. So you can see that this can be, I had a cousin who had a stroke at 62. She was in a nursing home for 14 years, paralyzed on one side. You just don't know. And that's what the next question is getting into. You know, strokes, paralysis, dementia, whatever it can be just a very, very, very long time, way more than the average. Is there a chance my self-funding account could lose money or not grow when I need care? All you have to do is point at the economy today and see what's going on with the market and real estate and all that. So a bear market that won't go away. I love that phrase. Will I have to pay taxes on the money I use? Yeah. So many people, most of their money is in these pre-tax vehicles, and then they're going to pull them out. And this is where I love the whole Benefit Buddy comparison that Jason can show you in a second, where it shows you how the insurance is so much more efficient when the benefits are tax-free. And the new Equitrust Bridge annuity that anybody can get, that's where that money comes out tax-free. And I hope you all will take a look at that. We've done some study groups on that. So is there a more cost-effective way to generate money for long-term care besides paying for it full price out of my retirement savings? And then emphasizing that this is something that could certainly happen at any age, anywhere. And today we have more choices than we have ever had to pay for long-term care. So I just, if this list will help you all, I hope you can take it to heart and use it.
Yeah, super important question. But especially when your client is going to have a conversation and may or may not come back. I just want to make sure you're being taken care of and proper due diligence is being done on this long-term care plan that might be drawn up for you by your advisor. And I especially love the question, if something were to happen to me today or even down the road, what's the first asset we're going to use? Right?
Yeah.
That's a huge
Because that
one.
could also be the asset they use to buy insurance with. And so, Jason, I know you're just dying to show us a leverage example.
Well, I was wondering, Linda, if you would feel comfortable sharing how you use Benefit Buddy. I've shown my approach a number of times, but I think since Linda does use it a lot and uses it on boots in the ground situations, it might be good to see another perspective. And I'm willing to do a juggling act while you pull it up for the time being.
Up right this minute.
But you make a good choice, Phyllis, or make a good point. If the first asset is something that you can use to fund a leveraged long-term care plan, like an existing annuity, for example, I mean, how many advisors are going to know right off the rip that they can take advantage of the Pension Protection Act for a 7702B long-term care annuity, right? That's an opportunity that they find the money, right? They understand every asset, and you understand best how to leverage it for long-term care. So
exactly.
super good point.
All right, so we're ready.
Okay, yeah, you can share whenever you're ready.
Okay.
I did not know you were using it, Benefit Buddy, all this much until we talked yesterday about how you're using it for self-funding. So I think seeing it from a different perspective will be good.
I absolutely love this in terms of self-funding, because that's really what it's all about, right? That's what everyone's, what is the option that people do? Well, I'll just fund it myself.
Are you able to zoom,
make it bigger.
Linda?
Make it bigger.
Three dots in the top right-hand corner on your browser. Yeah, zoom to maybe.
There we go.
Yeah.
Is that better?
That good?
Okay. Everyone can see now?
Yep.
So it doesn't really, from the most part, it doesn't matter which state, they're mostly the same. But so I usually start out with the traditional care. Now, this is just something to help people make decisions. Okay, so I'm going to tell you another strategy. I'm going to present this, and I'm going to just teach you something. It helps people process things in a more positive way. Okay, so I start off with, like, say I'm looking at a 6-year individual policy. It's a male, obviously huge leveraging on the male. So this is traditional. So this is the NGL policy. And I say to them, it really doesn't matter what the annual premium is, because whatever the annual premium is, we're self-funding it. So if we doubled this here, all the numbers would double on both sides. So what we're really looking at is, for any premium that we choose, what does it mean for us in terms of leveraging our assets? So in this case, a 50-year-old male goes into claim at age 85, and I usually ask them, when do you think you'll go into claim? Pick an age, and and then if they don't know, I say, well, just so you know that the average is 80, but many people who are feeling healthier and a little older prefer 85, right? So, and so down here, you put down that it's an annual recurring premium for a traditional policy. We'll say $6,000 a month, 6 years, 3% compound. We're looking at 11.9 multiplier. So that's a $1.3 million tax-free benefit. And if we compare it, and I'll ask them, what would you expect your rate of return to be with 95% accuracy? In other words, you will depend on this inflation level. And most financial planners, when I ask that question, will be between 5 and 6%. That is all they're willing to do on what they consider a 95% accuracy. And it takes them a while sometimes to pull up that number, because in their minds, they often talk 7 and 9% that they can do in the market. But you push them to a 95% and they drop it down to between 5 and 6. But even at 6%, you'll see that the rate of return is still so much better than with the insurance than a tradition with self-funding. And let's look at a female. Even though a female is much more expensive, you're still getting, you know, more than twice the leverage, right, on a longer policy. Now, this is true when you get to small policies for females, the leveraging goes down. Okay, still leveraged, and there's a lot to be said for what that's still an entire multiplier, you know, 100% more in one area of benefit. You're still getting an extra $100,000 of benefit, which is significant. But on these smaller policies, this is where it's very important to think about the additional benefits of long-term care, the catastrophic care of the partnership and the Mass Health Lien Law protection. Because if people can only afford a 2-year policy, then it means that they really need those additional protections. The shared policies look even better, or look as good, I should say. You know, and obviously age plays in a role, but here you are.
You've got 2 females, just so you know.
Actually, it doesn't make a difference.
Yeah, true. With NGL, it doesn't.
Yeah, NGL, 2 males, 2 females, male and female. It's gender neutral once you get into the shared. Here you go. So here you go, 16.5% on a 6-year for a 50-year-old couple. So huge, huge, huge. Now
16.5 times.
Yeah, 16.5 times multiplier, because
Yeah.
you know here we have 862,000 versus 4.2 million tax free. So now, I don't know if any of you have read, I think it's called Fast Thinking, Slow Thinking, but there's a lot to be said about a visual and how we interpret it. So you always want to focus on, if you are showing a 6-year times, you know, you're showing so this is a 6-year shared policy, 6-year shared, and you might be showing a 4-year shared, and you might be showing a 3-year shared. As you see, the multipliers are going down, down, down. So if you're showing like a 3 and a 4-year shared, on this I always show the 4-year shared. Most of my clients are not going for the 6-year shared. We usually go between a 3 and a 4-year shared. I will show the 4-year shared, and then I'll say, and they can see they're getting 4 times more value with the long-term care policy than self-investing, even at 6%. And then I'll copy it and I'll send it home with them to look at. This number stays in their mind even when they look at the 3-year or the 2-year policy, because the concept they get from this is the value of long-term care, that long-term care leverages your assets. They see it, they've looked at it, they've heard it, and it reminds them of the extreme value of long-term care. There was a study done in that book with a roulette wheel, and they spun the roulette wheel 3 times, and every time they had it set up so it would land on a low number. Then they asked the participants a question that really had no answer, and they gave them a few choices, and 80% of the time they chose the low number. Then they did it just the opposite, and they had the roulette wheel land on a large number. And then they were asked the same question, you know, others were asked the same question, and 80% of the time they chose a large number. So what it tells us is that when people have a visual and they have an understanding of something, they apply it much more broadly across the other areas in which that related or unrelated. And this is helpful to you because we know that our leveraging of long-term care is important. The value of long-term care is important. If we can help them understand and get it in their brain with larger numbers that this is an important leveraging concept of insurance, that is what gets embedded in their mind. And then when they look at all the policies, they're still thinking, this is leverage, this is leverage, this is leveraged. So it's helpful to have them see this leveraging at it's something you're obviously showing them, and you can send them this to remind them, and in their minds, for most people, it will go across all of the long-term care policies as the reason why you need to purchase long-term care insurance fees, because of the cost benefit of long-term care. And they won't remember that it's 12.1. They just remember that it's a significant number.
That the scales were very tipped. Yeah. And it's like Steve Elliott says, people think 7 times faster than they can talk too. So this visual is going to stimulate a lot of that thinking as well.
You see the
Mark,
question, Jason?
yeah. Mark, to your question, we don't have a PDF format just yet, but you can use the share button to send a link, which is going to, if Linda can also save the plan to revert back to, but that share button right next to the save button up at the top will actually generate a link that you can send.
Easier. Do you have a clip button, like a clip thing like this? Like it's, and I do it.
That's your other approach too. Yeah.
I just do this, and I just snip, and then I save, and you can copy it right into an email.
Yep.
So you don't even have to, you know, it's as an attachment, it's one thing, but you can embed it right into the email so that they can see, you know, be reminded of this right when, as soon as they open the email, it's right there. So if they're opening up the other attachments, it's still right there, right in the email.
Yep.
So I don't usually put this as an attachment. I usually put it as you know, right in the base.
PDF
guys,
is in the queue.
I would like just 1 minute, 60 seconds before we get done to talk about the smaller plans for,
Go for it.
Yeah. I mean, if you start looking, here we go. How many times have we heard this? You know, middle income Americans. So I think the cheese has moved, and I'm one of the biggest components of partnership. I helped get it in the country and all that, but I had to point this out. In the states that allow the short-term care, and this is also true, I'm working on a blog right now about when people are reticent in an economy like this to buy anything, you know, here is a starter plan that people can get into with a lot of coverage without spending a lot. But look at the leverage. This happens to be, this is the Omniflex product with Manhattan Life. This is a friend of mine, 62 years old.
Oh, we gotta share your screen.
Yeah, let me stop.
I'm sorry.
You go to you. You could share
Thank you. Thank you. I was so excited. I was just talking to myself. That happens a lot. Here we go, Manhattan Life. And the article that I was just showing you was this was Insurance Newsnet. And I'm like, how many times have I heard this for the last 20 years? Middle income Americans. Okay, so here we go. 62-year-old female. I'll show you without inflation. It just does the $400 a day facility, which is like $12,000 a month, $300 a day home care, like $9,000 a month. No deductible at all. So her premium is $159 a month, which is $1,900 a year. So for 20 years, I think I went out $47,000, something like that. Did I go out 20 or 25? Whatever that is, 160, let's see, times 20 years. No, I went out 25 years. Okay, 25 years, because she tells me she's not going to need care till then. So those benefits, that's $250,000, you know, for putting in like $48,000 in premium. If you add the inflation, the inflation is different. You wait till year 6, they're protecting against anti-selection. Then it kicks in at 5% simple, which means 5% of the original amount. And so it doubles in 20 years. So in year 26, she's going to have $504,000 in benefits that she spent $82,000, $83,000 for. Will there be rate increases? Sure. But look, it's a big difference between $83,000 and $500,000. So once again, you're showing the leverage. But the important thing is if this person has a claim sooner rather than later, these are very robust benefits for a very small amount of premium. And then, yeah, maybe, especially if you do this with somebody younger who's reticent to buy, they can always add to this plan in the future and just continue to get more coverage. So I wanted to throw that in.
Yeah, 100%. And I think the a little bit goes a long way conversation can carry a ton of weight. And if you feel like you're losing people and you're not trying that approach and going from self-funding and switching to cost of care and saying, here's, what our plan will cover as illustrated
Mhm.
here. Here's what the cost of care is. This is our gap. How much of this do we want to self-fund? How much of this do we want to leverage with insurance? I think those are pieces of the conversation that can go a very long way as well. Make the client and advisor's initial approach on self-funding to be, look, let's do a little of both. I think they can both work together.
Mhm.
So let's dial it in and see how much we can do. I think that can really help you get somebody to move forward with something that's going to really help them and give them access to a long-term care professional that they really, really need, advisor and client. But we are right at the top of the hour. This was super, super information dense. I really enjoyed the conversation and just listening to you both. I thought we covered a lot of really good points, whether it's around financial advisors or otherwise, just greater long-term care. I really appreciate what you had to share with everybody. Is there anything you want to leave the group with before we wrap it?
I don't feel like I really made my point about that short-term care, but if people can only afford a small plan, frankly, I'd rather see them with that than 4,000 a month and 3% compound, because it would give them a whole lot more coverage immediately. Yeah, that's all. I didn't finish that very well. Linda, thank you. You're such a pro, and she sets an example for all of us.
Agreed. Agreed. I look up to you both immensely. I want to be like you when I grow up in the long-term care industry. So thank you for
You want
just,
to have white hair like me? Okay, I got it.
I'm going to be there eventually, so might as
I'm
well
never,
get
I'm
used
never
to
turning white.
it.
Oh,
Well, thank you guys again very much. Hugely valuable. Thank you everybody who joined us today. And for next week, I have the Insurance Collaboration to Save Lives coming on to talk a little bit about their findings in mortality and morbidity trends and what we can really learn from that kind of more for recent years. So that'll be interesting, a very tangential, but I think informative call that will give you a lot of talking points. And then the week after that, I have Kimberly Lips from John Hancock coming in because many of you have asked me about it. And she is going to give us the lowdown on John Hancock's new life care product, their new
ooh.
hybrid plan. So that's been highly anticipated by many, and your wish is my command. So we got a pretty cool couple of weeks coming up. Thank you for being here. Appreciate you all. Thank you again, Phyllis and Linda, and we'll talk to you this time next week. Have
Thanks,
a good one.
guys. Thanks,
Awesome.
Jason.
Thank you.